about investments. I find that exciting, particularly these days. The markets are nice and volatile. Okay, so I'm very happy I chair the investment committee. We have 3 other members on the committee with us, and we work with the team. So the answer to which word is the most fun, the investments are great. Zoo is really terrific. It is more fun than anyway, I do this. I do Arizona Board of Investment. We've got about $31 billion down there, and so I get to go down and visit the money every month. The Treasurer's office. We're doing real well with collecting marijuana tax. So that's going well. Some of the other things not so well. Anyway, I've been here in my 7th year, and I want to talk just a little bit about what we do. First off, performance last year was 7.64%. I think I read it today for the calipers was like 4.2%. It's a shame about calipers. Just don't let them get hold of Mark Steed's email or a telephone number. He's shaking his head because he knows the half-life of the CIO calipers is about 9 months. So it's not been a great place. Anyway, we had strong performance compared to our peer group. We have an investment committee. We have 4 members. We have Chris Hennon, who's a state trooper. We have Randy Stein, who's an investment professional. And we have Dean Shiner, who is used to be the investment professional. He heard lunch, he moved over to work in the not-for-profit program, which is a great thing for him. Anyway, the investment staff is also fully we have no vacant positions now. We've added some staff over the last year, and really over the last couple of years. And the quality of the people that we brought in is really amazing. So it's certainly true in the county administration. That is all changed since Mike got here, and the investment team has really been beefed up as well. Portfolio volatility, we'll drill down on that in a little bit when we get to one of the slides. We've done a really good job. We pay a lot of attention at trying to reduce the volatility of the portfolio, but still have enough upside potential to earn a reasonable return. Liquidity is really an issue, and we have an awful lot of illiquid assets, and this is a great way for pension plans to get in real trouble. If you don't know how much cash you've got to have available and the markets are volatile, you can get yourself into a position where you're stuck with too many illiquid assets. And the worst case scenario is you end up having to sell some of those at an inopportune time and take a real haircut on sales of that. That is not going to happen. We are all over the status quo line. The good news is $6 billion, and $5 or $6 billion been put in voluntarily by employers over the last several years. So like $600 million a year. That's great, but the flip side of it is because that money's come in, there's less new cash to come in, and as a result, the cash flow, though the net cash flow is slightly negative. So we're a little bit more like a typical pension plan. But we're all over that. We understand it, and we're also well positioned. We've got roughly 12% in cash and treasury bills. We really did well in 2022 calendar year was a tough year. It was a year with nothing. Bonds did not do well. Normally, when stocks do very poorly, bonds will do well, and vice versa. Well, in 2022, nothing worked. But fortunately, we had an awful lot of cash and treasury bills, so we really did get hurt on that, which was really important. Let's see. Next. Processes, there's all kinds of, there's new investment book of record, there's all kinds of technologies being deployed in the investment department, that will help the team make, real-time decisions, a lot faster. The expenses, I mean, there's no question, uh, if we save money and spend less on expenses, that is just like adding returns. So it's really important to control the expenses. And over Mark's tenure, we have certainly shifted a lot of assets from higher cost investments to public markets and index funds where the cost is nearly zero running that. So that has helped a lot. And also economies of scale, just the sheer size of it, when you're a $21 billion plan, the expenses are a little less than if you're $8 billion. So it's all good. Investment management, governance, the committee. A long time ago, the committee used to, and the board used to make decisions about purchasing and selling individual stocks. Raise your hand if you think that's a good idea. That's a terrible idea. So what we do from the committee perspective, we're obviously tasked with oversight, but we pay a lot of attention to asset allocation. Depending on which studies you look at, a lot of them would indicate that about 90% of your return will be driven by asset allocation you select. So if that's the thing that's the most important, it's where we'll spend most of the time. So we focus on the asset allocation. We have investment policies, and obviously we have to have compliance with that. To do that, we have a board fiduciary consultant, legal pension consultants, our longtime consultant, Alan Martin, just retired. We have Rose Dean, who I have a lot of confidence in. She's relatively new to NBC, but she came on, and she was highly regarded there. The other, so the NBC actually technically works for the board, and they evaluate quarterly performance and deliver that information to the board. Not that I'm terribly concerned that anybody's going to change any of the numbers or come up with something that's not accurate, but if there were a discrepancy, we would find that out pretty quickly from an NBC. So I do think it's a best practice and improve work on evaluations and performance. And present quarterly performance and return attribution, which is a statistical analysis of where the returns are coming from, where the deviations are, and that will tell you if you have an asset class or if you have individual investments that are not performing as you might have expected, and it'll point you to where you ought to make a change. And by portfolio oversight, monitoring compliance, they also work with the staff and the actuary and the investment committee to set the asset allocation and long-term return expectations. Each year, we look at the pension consultants and all of the others, Wilshire, BlackRock, and Cambridge. They all come out with their assumptions for what each asset class is likely to return over the next 7 or 10 or 20 years. They also come up with correlations. So very important to have assets. It's helpful to reduce the volatility and the risk in the portfolio, to have asset classes that are not highly correlated with each other. So it's important to come up with a guess of what you think various asset classes might produce. It's also important to try to understand how correlated those different asset classes can be. Okay, so key committee presentations. We look at portfolio performance monthly, quarterly, fiscal year to date, calendar year to date, 1, 3, 5, 7, and 10 years, all broken down by asset classes. And again, that's going to tell us if something's not performing. If we look at this 4 years ago, joint venture real estate would have jumped out of the page and said, you guys have a big problem here. And if you connect the dots, the solution would be, let's not have any joint venture real estate. And lo and behold, we don't have any joint venture real estate. We connected the dots. Risk analysis, we have a report each month that identifies what the major risks are. We also do a stress test. We've been doing this for a long time. The legislature thought it'd be a great idea for us to do that. We agree, we've been doing it, and we'll show you a sheet on that in minutes. We also get an update on global financial market developments. There's lots going on. We have lots of volatility. There's a lot of uncertainty. We've got 2 shooting wars. We've got inflation. We've got an election coming up this fall. Sort of half the world has elections coming up. There's lots of balls in the air and lots of volatility. Quarterly, we have again a detailed performance review by the independent fiduciary consultant, that's NPC. We also get updates on trends in institutional asset management. And annually, we revise, we consider making changes to the asset allocation and perhaps adjusting the rate of return. Let's see. Okay, here's a snapshot of the portfolio. It's broken down into investments that are trying to earn capital appreciation. That's where you go out and buy NVIDIA today, and you hope that tomorrow it'll be double. And NVIDIA hasn't done it, well, it's only up 50% this year. In fact, they're getting up, I don't know, 300% last year. It's amazing. It's not in my portfolio. It is an important point, important part of our portfolio. We have the Russell 3000 for domestic equities. And I think NVIDIA is now number 3 or number 4 in that portfolio. So we have a significant. So we better hope NVIDIA keep growing every day. Anyway, U.S. public equities, those are almost all indexed. We learned a long time ago that for a variety of reasons, PSPRS is not good at selecting active managers. So again, you connect the dots. If you're not good at it, let's go do something else. Let's pay almost nothing and have a really easy portfolio to manage. So we're in the Russell 3000. International public equity, same thing. International, we could be in Russia. We don't think that's just a great idea. We could be heavily in China if we were in emerging markets. All the emerging markets funds are 40% Chinese. We don't have that exposure there. We're mostly in established, mature international markets. Private, we have an awful lot of private equity. Private equity is difficult to manage. You have to find good managers, and it's very difficult to size private equity. It's easy to say you got $21 billion and you want X% of that in the Russell 3000. You could just go out and buy that. Tomorrow morning, you would be at exactly the target allocation. That's easy. Private equity, private debt, it's very different. We make commitments to private equity. First, you're going to find good managers, and hopefully they'll be consistent so you can participate in future years as they add additional programs. But you make an allocation, and then they draw down those funds over a 2 or 3 year period. So you don't really know how quickly you're going to get to that allocation. You also, if you have existing private equity, something terrible happens. They sell stuff and you get money back. So you can't really control, you can predict maybe the rate at which money will come back to you from the existing investments. You can maybe predict the rate at which commitments will be drawn down. But these are moving targets, so it takes a lot of work by the investment team to manage that. That's private equity. Opportunistic real estate, you couldn't just buy a hotel and collect the rent, and that's That's not an area we think is particularly fruitful. We're looking for real estate investments where the manager has good experience and track record and doing something to improve the value of that particular property. We've got high yield bonds. We don't have much there. We also have emerging market equity and emerging market bonds. We don't have much in those areas. Contractual income. This is living coupons, and the objective here is to just collect an annual return, hopefully 8 or 9 or 10%. The U.S. Treasuries today, we have an awful lot of T-bills. They're yielding 5.25%. Obviously, that's less than the 7.2% consumer rate, but it's a whole lot more than we would have gotten in T-bills 2 or 3 years ago. And it does greatly reduce the overall volatility and risk of the portfolio. And 5.25% is not a bad return. It's something that's easy and essentially risk-free at this point. So we have a lot of those. We have investment grade bonds. We have an awful lot of private lending. And after the great financial crisis in 2008, 2009, there were lots of changes in the banking system. And before 2008 to 2009, banks tended to loan money to smaller companies. Big companies like Procter & Gamble or General Motors or Exxon can borrow all the money they want out of the marketplace. But smaller companies don't have the ability to issue publicly traded debt. So historically, they've been serviced by banks. Well, all the changes in the Dodd-Frank after the banking crisis, banks are pretty much out of that business. And as a result, there are private lenders who we go out and hire, and they make a series of loans, and we'll get paid back over time in most cases. It is cyclical. We will have another recession. I don't think we'll have one this year. We didn't think we'd have one last year or the year before. Eventually, we'll have another recession. When we have a recession, we're going to find some of the private debt is going to default. And we'll hopefully get some pretty good recoveries from that. But we're getting something in the vicinity of 10% on private debt at this point. And that goes a long way towards our 7.2% school grade. We also have a relatively minor amount of money in leases and royalties. Again, this is just contractual income. We also have a small amount in diversifying strategies. These are hedge funds. Hedge funds tend to do pretty well during periods of very low inflation and very low interest rates. That's not really the environment we're in at this point. They're also very expensive, very dangerous, because the people that run hedge funds they get paid a lot and they do very interesting things. And if you have those, you don't want them to make interesting things with their money. So it's again, it's not our asset class to manage. We are de-emphasizing that. I think it's down to roughly 4% of the assets. So next up is portfolio performance. Blue bars for fiscal year. You can see on the page here, all of these periods have exceeded 7.2%. But I have to emphasize that even with the pandemic, the last 10 years has been a very good period for the stock market. That's been such a good period for the bond market. It's been a very good period for the stock market. And so if I were in the legislature trying to pay out 8.9% from the state permanent land fund for the next 10 years, I would think that it's not such a good idea. We're going to some discussions about that. In any event, scenario, this is the stress test. I'm really proud of what they're doing here. And it's not 100% certain, but this is an analytical approach that tries to determine how our current portfolio would do in stressful events that have occurred over the last 20 or 25 years. To tell you what looking at, the gold bars tells you what the actual PSPRS portfolio did during the 2001 September 11th attached. This portfolio is down 11.7%. The blue bar is our best guess at how our current portfolio would fare in a similar event. And by my eye, the blue bar in 2001 is a lot different than the orange bar. And this tells me that the construction of the current portfolio is likely, during a very stressful time like that, to likely perform a lot better. The green bar is now a 60-40 stocks and bond portfolio would have done. It's our best estimate of that. So not being critical of where we're standing here in 2001, but I won't say they did a bad job, but I will say that I sleep better with the blue bar rather than the gold bar. And as we go down this list, you're going to see that the current portfolio is very different than it was in 2001, but it's very similar to what it was in 2020. So we made the change, we're in the right position, and you'll see that in a minute. So the 2002 stock market crash, portfolio was down 20%, significantly brought down. This portfolio would likely be down about 7%. Interestingly, 60-40 portfolio didn't do very well there. August 2007, you can see this portfolio would be down a little bit. The actual portfolio was down even more. Again, 2008, great financial crisis started then, pretty similar. 2008, credit crunch, the great financial crisis. You can see the portfolio here was down 23.1%. We think our current portfolio will be down 12%. Again, a big difference. But then we look at 2009, again, down almost 13%. Our current portfolio may be down 4.8%. But when we come down to the bottom of the page and look at the 2020 pandemic, we were actually down 9%. We weren't down for very long because the market came roaring back. Our current portfolio, they may be down 8.8%. What that tells you, in fact, that the gold bar and blue bar are pretty similar, tells you that the portfolio hasn't changed very much since 2020. So we've migrated to where we want to be, and we're happy with where we're at. And this portfolio is designed to protect much better than down markets. The element going forward, here are the capital market assumptions, and we've listed two vendors, NEPC, who's our consultant, and JP Morgan, who's obviously well known in the news. And you can see that NEPC over the next 10 years thinks large cap US stocks will produce only 4.4%. I've got a slide in a minute that'll show you how large cap stocks have done historically. It turns out to be about 10% over the last 90 years. So 4.4% expectation is a lot lower than the historical average, and that's because we started at a really high level. The market's at high levels. JP Morgan is a little more optimistic, they're at 7%. US private equity, NEPC's at 90%, JP Morgan 9.7%. Private lending, 8.3, 8.5. Emerging market equities, you see emerging market equities is 40% China. I can tell you that I don't have any money. They're looking for 8.6% versus 8.1%. US real assets, that's timber, it's real estate, it's things that we tend to do well in inflation, about 6.8%. US government bonds, today you can get 4.1% 10-year treasury. I think that those yields are likely to go up rather than down. But NEPC is looking at over 10 years, and they're still 4.2%. JP Morgan 4.6%. And international equities 4.6% for NEPC, 7.2% for JP Morgan. JP Morgan's a lot more optimistic about the public markets. Next page is one of my favorite graphs. This is a study going back to 1926. So almost 100 years. I have to warn you, it's a logarithmic chart. So the difference between $1 and $10 is one increment here. That same increment is a $900 increment. And the reason we put this on a log chart is if anything is growing at a constant rate, if you put it on a log chart like this, something growing at a constant rate will plot out as a straight line. And your eye can sort of see, my eye sees the orange line on the top, and it's pretty easy for me to draw a line. If I had a big ruler, I could lay down that ruler and see what pretty much the slope of that line is. It's been fairly consistent. There are wheels and jiggles for sure, but you can sort of see the trend line there. You can also, so the yellow is small company stocks, the blue is large company stocks, and I'll just tell you the yellow return has averaged about 12% over the last almost 100 years. The blue large company stocks has averaged about 10%. The green is corporate bonds, and it stops because it is to start tracking those. The blue is government bonds, long government bonds, and those have been about 5.2%. The purple is treasury bonds, and the yield on that has been about 3.5%. And the important thing is on the bottom, the green is the inflation. That's been about 3%. So over a very long term, if you wanted to know how is the stock market going to do in 2038, what's the inflation rate? What's the primary rate? Who's in the White House? Who controls Congress? How did the market do in 2037? We don't know any of those things. So how's it going to do in 2038? 10% on stocks, 5% on bonds, 3% on inflation. But if you look at the 10% net inflation, you get a 7% return. If you look at the bonds, 5%, net inflation 2%. The stocks, if the futures like in the past, stocks should go like that with bonds. But on the other hand, you know, the liquids which used. But Clark will tell you it's going to be a long time before the last tier 1 employee passes away, or until his beneficiary passes away. It's going to be a long time. And so, by and large, we can live with the biggest contributors if we have a very long time price. Okay, Mark Steed is our Chief Investment Officer. He's been with the plan for, I don't know, 15 years. 15, yeah. But he's been Chief Investment Officer for 5 years, and you're going to get to see the before and after. I like the after better than the before. Mark?
Thanks, Eric. Yeah, appreciate that. And I realize just the noise out in the hallway, so for those of you that have FOMO, we'll try to move it along here. But it's not your set, it's not our group you're missing out in the hallway, it's the other venues. So I appreciate Harry taking you through kind of the markets. I was sitting in the back, I was like reminded when I was young, my grandpa was pretty much taught me everything I needed to know about investments. He would come over, and every time he came over, he would always get this dumb joke, which I now like because I'm a dad, so now it just has a terrible mix of like investment jokes and dad jokes. And so he would always come in and he would say, Mark, helium is up, feathers are down, paper remains stationary, right? Knives are up sharply, get going. For the rest of the tubing is dimmed in light trading. That was another one. Escalators are up, and about that time, my mom would yell from the other room, "Yeah, the diapers are going to change." So I appreciate Harry's talk. I'm just up. Okay. Sorry about that. I just had to get it off. I'm gonna wrap this up by just going through my scorecard. So I really have four main priorities, and those priorities are just a function of our investment policy statement. They're spelled out right there on our statement, and the board approves that investment policy statement. They develop it in concert with the fiduciary investment consultant. So I have 4 goals, and the first goal, is surprising, is to hit the conservative trade. So try as best you can. We're not going to control it all the time. We're trying to deliver a rate of return that's above the assumed rate, which is 7.2 right now for tiers 1 and 2, which is the majority of the capital. So we have those numbers that are through performance. The second one is just make sure you have money when money is due. That's really important so that we make sure we have We actually have liquidity to pay the pensions. You can see what we have right here are just some expectations of cash outflows, which will change certainly as actuarial assumptions change. But you can see if we look out sort of 10 years, about 2 to 3% lead, which is easily managed through the portion of the portfolio. Harry said we have about 12% in cash, and that's a mix of cash and treasury bills. So we have no problem handling that kind of outflow. And also very mindful, though it's not on the chart here, very mindful about intra-fiscal year cash fluctuations. We have contributions coming in, we have benefit payments coming out. We also have investments, we work, some dividends and other income coming out of investment. So it's really important that we actually keep on liquidity, because as we said, by the time we realize that liquidity is important, it's probably too late. So we want to make sure that we're ahead of that. So we have no problem hitting the return assumptions, we have no problem with the liquidity. If we look at volatility, which Harry mentioned, we're trying to mitigate volatility where we can without sacrificing return, because if we drop the assumed rate down, and generate less investment income, that obviously varies the contribution rates of our constituents. And we also don't like raising the contribution rate. We also don't like there to be a lot of contribution rate volatility because it's difficult to plan. So we've tried to manage volatility. You can see here it's fairly, the standard deviation is just $10 statistics term. That's effectively just a volatility of the program. Higher numbers are means more volatile, lower numbers are less volatile. So we managed to deliver returns that are volatile than 90%, less volatile than 90% of our peers. So the lower numbers here are better numbers. And then we managed to manage expenses as well. So we try to accomplish those three objectives plus the fourth one, and so we try to all this for as little money as possible. And a 30 basis point drag from expenses is about what we're at. That's been higher over time. As Terry mentioned, pushing those costs down by moving into more cost-effective liquidity index options. And we'll continue to move that direction. I'll just finish with this. Our peer comparisons now, we don't really manage to our peers because every pension plan is a little bit different. They have different liabilities, they have different cash flows. So it's just human nature that we want to compare plans and relative performance to other pensions. But this plan is probably the poster child for why you don't want to do that. Those of us that have been around long enough remember the permanent benefit increase, which was every time you had a return above 90%, you had to take half of the returns and increase pensions. So it was a really kind of odd system where every time you had high returns, you goosed everybody's pensions, but then eventually those returns fell off and we couldn't take the pension back. So it really kind of created it wasn't structurally meant to do that, and over time I think it was unintended consequences. I think were eventually discovered and changed back in 2015 or 2016. At any rate, we want to make sure that we're competitive and we're in the top half of pension funds. So you can see 9/30 in 2018, that's when I started, that's which is about 5 years. We were pretty much in the bottom 10 to 15% of our peer group, which meant if you look at return to the pension fund, for the most part, they were doing better than we were. And even though we didn't want to compare ourselves to other pension plans, that was a little extreme. You'll probably also never see us being number one, because by definition, if you want to be better than average, we're doing something different than all the other pension funds. We're under a prudent person standard, so we're not always going to be gunning for number one, because the kind of entities might be doing things that are a little too far outside of it. What we're trying to do is be in the top half to the top 25%. So since we've reoriented the portfolio, you can see that the numbers have improved dramatically. It's kind of tough to go from kind of bottom 10% to the top half. The 3-year really looks really good. That's been a function of some market decisions that we've made, but then also just randomness. And then you've got a portfolio with a lot of cash, and cash comes from extra contributions, and you've got a volatile market. You're going to look better relative to your peers who were, maybe had more stock-heavy portfolios and enjoy kind of the ride down more than you did. So, really, as I said here, it's just been a factor of just a mix of assets. When I started, we had 10 different asset classes, and consolidated those down to 3 major asset classes that are able to capital appreciation, where you buy something, the company buys it for you more than you pay for it. And then you have income, which is usually your piece of paper, or your return to spell out by a piece of paper, and then anything that's not those two things. And we found that it reduces the number of asset classes actually being the investors within those asset classes compete, so you have a more efficient return for each of the asset classes, and that's been a huge generator of returns. Then cost management has been the other focus. We always do better with expenses, and like I said, anytime you save money, it's an automatic increase in returns. So I think I'll pause there and see if you have any questions, but I appreciate you sitting through and speaking to us as a portion of the meeting today.
I will tell you, so my day job, I'm an investment advisor. From time to time, you have strong opinions. I did have a meeting about a week and a half ago with the investment team. We talked about inflation, interest rates, what's going on in the financial markets. Personally, I don't think inflation is under control. I think that's going to greatly limit how much the Federal Reserve can cut interest rates this year. If that's true, the marketplace is still projecting 4 rate cuts this year. I don't think that's going to happen. PSPRS portfolio is way short of the average maturity or duration of the fixed incomes. There's a lot of treasury bills. And we're a little short of our benchmark, our target on equities at this point. And my advice is to stay a little bit below the target on equities at this point. Because if it turns out the inflation is not under control and the interest rates can't be lowered very much, I would not be surprised to see the market come down a little bit. There's a lot in Florida. There's also a lot of craziness in the marketplace. There are 7 stocks last year that accounted for something like 85% of the return in the entire Standard & Poor's 500. When I was in grad school, I was taught that the Standard & Poor's 500 is a broadly diversified portfolio. It's not. There are 7 stocks that make up 30% of it and drove 80+% of the gains back. If we had those 7 stocks like we did, successfully wrong, we did great. If you didn't have those 7 stocks, the rest of the market was very young. And the last time we've seen this happen to this degree would have been in 1999 and 2000, the dot-com era. And I'll just tell you, that didn't end well in 2001 and 2002. So there are lots of differences, but there's crazy stuff going on. There's Bitcoin, there are nutty things going on, and I think it's time to be very cautious.
Maybe we'll add to that point, Harry. This might be tough for your personal portfolios, but this environment where you have rates around 5%-ish, call it. You've probably seen that in your money market accounts, seen that in the Treasury, T-bill market. That doesn't bode well necessarily for a lot of asset classes, but for a public pension plan where we have in our case, a 7.2% student rate. That's a nominal rate. It doesn't matter if it comes all from inflation or if it just comes from feel like correct. So the nice thing about being a pension and being an institutional investor is you have a lot of options right here, the contractual income bucket. So when you combine stocks, like Harry said, you know, a lot of volatility in a lot of ways. Valuations low for little-ish right now. That makes it difficult when you're sitting around trying to figure out how to allocate your personal portfolio. And maybe you don't like that as an index fund as much as you did a year ago, 2 years ago. It's an easier problem to solve for us. One, we don't, from an investment standpoint, care too much about inflation by itself. When interest rates go up, that's fine because now we have invested, we have cash and we can invest in securities that generate a rate of return closer to your true rate. 2 years ago, we couldn't get 5% in T-bills or money markets. It was 0. So things happen, but now that all these employers made extra contributions, $5 billion of, we just got very, very lucky and then rates moved up. So instead of earning 0% on our cash like we were earning 2 years ago, now we're getting over 5.5%. So we don't actually have to stretch that much to go from 5.5 to 7.2, which means we can kind of pull in the risk a little bit. We don't have to reach over out versus back. When rates were 0 and we had to hit 7.2, if you're not earning the risk-free rate by definition, you're doing something risky. Okay? Not only have to take risk to make a return. 5 years ago, we had to take a lot more risk to generate that 7.2 because the risk-free rate is 0. Now the risk-free rate is 5.2. So it's a very fortunate circumstance for us to be in. The other thing we can do, Harry mentioned private lending. These are floating rate loans. So they're based off the risk-free rate plus the spread of about 5 to 6% and it's floating. So as rates move, that interest rate moves up. So before, when rates were 0, we were making about 6 or 7% on those investments. Just looking at coupons, as long as the borrowers didn't default, we achieved our 7 to 8% return. There was a 5% spread up front, 1 point origination. That's effectively how it worked. Now that the risk rate is 5.5%, 5%, now you have 10 or 11%, just put the coupons, making loans to businesses who have about 50 million in earnings. They're not small. These are large businesses, 50% loan to value, 11 to 12%. That's actually an easier problem for a bank to solve. You don't really have a lot of those available with personal loans, but it's actually not the worst problem in the world for a bank to make.
I will tell you, when Mark said 2 or 3 years ago, you got 0 on treasury bills or money funds. There are plenty of people you know or you know of that were sad about that because they had tons of deposits. One of them was Bank of America. And visionaries of Bank of America came up with a great idea. Instead of earning nothing in the money market fund or treasury bills, they went out and bought some 30-year mortgages. It yielded about 2 3/4%. 30-year mortgages today yield almost 7%. So Bank of America got the right idea to buy this. They bought $604 billion worth. And they're not worth $604 billion anymore. They're down a little bit. They're down $130 billion. And because of an accounting quirk, they don't have to recognize that in their financial statements. And the quote, this was as of June 30th, 2023, and the quote from the CFO was, it's only $130 billion. It's just on paper. We're never going to sell those. It's not in later real loss. I think for too long, we'll have a different CFO, I think. And there are lots of things that do this. There are lots of organizations that awful lot of pension plans. Pension plans typically have 30% of their money in long government bonds or something similar to that. We don't have it. We didn't suffer a loss there. Arizona Board of Investment did not suffer losses because we were careful not to take any. With that, we'll see if anybody has any questions. I wouldn't buy Bank of America.
Anytime there's 2 professional money managers, I can come up with some questions.
Okay.
Back in 2000, we had the dot-com crash. 2008, we had the housing market caused by the collateralized loan obligations. A couple years ago, we had the COVID crash, although it was temporary. Where in the markets do you see next call?
Oh, goodness. The banks, there are lots of banks that still have serious problems, just as I described in Bank of America. There are also banks regional banks tend to be a lender to office buildings. A lot of people own office buildings and borrow a lot of money. My building, we just renewed our lease at the end of the year. And the people that own our building bought it in January of 2021 for $103.5 million. The building was 93.3% occupied. They were borrowing a variable rate loan. They were paying about 3.9% on $80 million. The building is now 60% full, and they still owe $74.4 million. But instead of 3.9%, they're paying 90% interest. So when we went to renew our lease, we talked to the leasing agent, and we said, if you could give us a reasonable deal, we'll renew the lease for 5 years. And if you can't, we'll do it for a year, and we'll try with the new ownership. They said, new ownership? What are you talking about? And we said, well, if the building's worth $55 million, and you owe $74.4 million, I would think instead of sending checks, you'd send keys to the lender. And this is what we're seeing. There are office buildings in San Francisco, Los Angeles, New York that are selling for 50 or 60% of what they sold for 10 years ago. And you're going to see an awful lot of foreclosures, particularly in office. This would have happened anyway. Work from home is a thing. It would have happened anyway, but COVID really has accelerated that. And there are too many office buildings. There's too much office space that nobody needs or wants. And office space doesn't just convert to apartments. in a year or two. It's going to take 4 or 5 years to get through that. And you're going to see a lot of bankruptcies. So I think you're going to see a lot of charges on regional banks. And my firm, we don't own them because we think that's a real problem. So that's an issue, the inflation is an issue.
I might just add real quick that I'll just say a word about AI and blockchain for a second. I'm a little more constructive on AI. Big players that are in AI, NVIDIA, Microsoft, Meta, and these are companies that have sort of diversified revenue stream. Well, it's not necessarily the same as the dot-com boom where you had a company that was just on paper with these huge valuations. So I think there's a little more substance to that general AI movement. The valuation are getting a little over, I think, over the skis. There's a lot of interest in that space, but I think that's a more legitimate area for growth. The valuations are pretty high right now. If you look at the valuations of the average company that's in AI probably 10 years ago, the valuations were in line with the rest of the market. Now they're probably twice in terms of just like the EV ratios that they get. I think they're a little more legitimate in that Microsoft has a business line, the business line. But I do think, I wouldn't surprise me if those valuations back down to earth, but I don't think that they're fake business models necessarily. Blockchain, a lot of questions about blockchain and crypto, but generally, sort of my personal opinions are one thing. But I do think that that's a different animal where you're looking at an industry that grew up with the intention of being untraceable and outside of the financial system. So all these attempts to sort of make them sort of regular way and give retail investors access to it through ETFs, I think that's a little more dangerous. Just because it's really like infrastructure and personalities, which is don't want to be tracked by man. And so I think there's a little more, just a little more concern about crypto and some blockchain that I think investors would be careful about. But I want to separate that from AI. I don't think either of them necessarily are bad ideas. I just think that there's a lot of excitement and a little exuberance. So I was thinking sort of cannabis probably 10 years ago. And you just need to sort of let those non-institutional players go away on the market first before they make a big story.
Carter?
Well, I just wanted to piggyback on what you said, Harry. I drove past a place where there's a strip mall, and they just leveled the entire strip mall, and they're building apartments. Is that like a trend that you see happening as the economy shifts, and what has happened with investments? That because we have a housing shortage and the office building oversupply, that's going to be a tremendous shift.
It is. And we had a housing oversupply in 2008 because in 2006, 2007, 40% of all the homes sold in Maricopa County were sold to people who didn't intend to live there. They were just going to sell it to the next guy and flip it and make 40% a year. As long as home prices go 40% a year forever, that works great. Didn't work so well in 2008, 2009. We have a way overabundance of office space, and it's going to take years and years to move that out. It's very difficult to change an office building to apartments. The easiest way is to bulldoze. Keep the apartment, but bulldoze it for the apartments. So I think you'll see a lot of that. I also think we're in a different period with inflation and interest rates. And I think we went through roughly a 20-year period where the federal government and others repressed interest rates and kept them at unsustainably low levels. And that created a lot of wealth for people. And if you look at the square footage of the average home built over the last 20 years, it's maybe 2,000 or 2,100 square feet. If you look at the 30 years before that, it was maybe 1,400 or 1,500 square feet. And their homes had 8-foot ceilings in the last 20 years. Before that, they had 6.5 or 7-foot ceilings. Now that the interest rates are higher, hopefully some of you have 2.75% and 3% mortgages. I don't think I'm going to live long enough to see a 3% mortgage rate. I think that was an extreme number. If that's true, if we've got inflation that's not higher interest rates, then I think you're going to see the size of homes being reduced. I think the 2,100 square foot homes will tend towards 1,600 square feet. And I think you'll see a lot more folks shifting from what would have been single-family homes before to apartments, and purely because of economics. But it takes a long time to adjust. That something is, a home is going to last 40 or 50 years. And if there's too many of them, it takes a long time to work through the backlog and reprice assets. Anyone else? All right, well, thank you for being here today.
Thank you.
Yes.